Welcome to Chapter 8 on forwards and futures options. This chapter is about valuing and pricing these contracts. Now, if you remember from Chapter 2, we talked about forwards and futures a little bit. And obviously in this chapter we're going much deeper. But remember what a forward contract is. A forward contract is a negotiated contract that's usually transacted over the counter. And so they're very specific. They tend not to be very liquid, and it's making a phone call to another institution to be able to arrange one of these forward contracts. Futures contracts, if you recall, are exchange traded for the most part, and so they're highly standardized contracts that you can trade very, very quickly. In a lot of cases, just filling in a little dot on the web on a brokerage application and hitting buy or hitting sell depending on what type of position you're taking. So let's keep in mind here now how one of these things operate. So remember, when you enter into forwards and futures contracts, and you enter into them at time zero, you enter in, and then through time t, some time t here, and then at time capital T, the futures matures. So remember, you go long, for example, corn. You're entering into a contract to buy corn, and you're going to buy corn in the future. So you're entering in today. You enter a contract, and then you actually transact sometime in the future at typically at capital T here at expiration. You technically don't buy forwards and futures, and we talked about that in Chapter 2. Although the textbook and I will, and the rest of the industry will often say you buy a futures contract. That means you're going long, or you're buying a forward. It means you're going long. You expect to buy the item, the commodity, in the future. That's why they're called forwards and futures. These things transact in the future. So technically, nothing changes hands at time zero. Other than possibly a margin requirement. Okay. So let's differentiate between forwards and futures. So remember now, again, another distinction between forwards and futures is forward contracts, like I said, are over the counter. They're negotiated. They're not marked to market every day. And so you enter into one of those into a forward transaction. Nothing really happens until expiration. So you enter in time zero, nothing really happens until time T, capital T here. With a futures contract, on the other hand, you enter in at time zero, and you're going to have to post margin requirements if the underlying commodity starts going south on you, so to speak, and so you start losing money. When you start losing money on the contract, you're going to have to pony up some money. And that's your margin requirement. So along the way, you could have a margin requirement every single day here. And in fact, you kind of do. You just may not be paying margin because you may not be losing. You may actually be gaining margin. They may be increasing your account for the gains that you have. Remember where those increases come from. If your account's going up, somebody had to pay you. And so the other party is losing. So forwards and futures are zero-sum games. So if you're gaining, somebody's losing, somebody's making margin deposits along the way. Ultimately, that gets credited to your account. So now the textbook talks about it talks about valuing futures and forwards, and then it talks about pricing them. And so before we go any further, let's get some notation out of the way. It'll help us a little bit at the beginning, this notation, but as we go further on, you really won't need the precision with the subscripts and so on here for pricing and valuing. So we want to make a distinction between, in the textbook early on is making a distinction between futures value and the pricing of a futures contract or a forward. The pricing has to do with how do you figure out what the futures price should be or a forward price ought to be. And then value is well, how much is it worth now once you enter into one? And so the process of valuing and pricing is important for your balance sheet. So how much do you record on your balance sheet for the value of a contract? It's different than the pricing. So again, with the notation, and this notation is very specific to your textbook, is first of all, the capital F's are for forward contracts. Okay, this is a bit different than nearly every other textbook and any material you ever see on forwards and futures. It's almost always the futures contract is a capital F and the forwards are a lowercase f. But this textbook has forwards as capital F. And this is a forward price. And so it's a forward price. It's a forward contract created at time t, so that's when it's created, and it expires at capital T here. Okay. Now you have the same thing with a futures contract that's created at time t, and so here's a little subscript here, and then it expires at time capital T. Okay, and we have value now. So we have value of a forward contract. Again, it's capitalized, and it's the value at time t for a contract that started at time 0 when it first was created at time t, and it expires at capital T. Okay, and then the value for a futures contract, and that's a little v, by the way. Can you see that? That's technically a little v. Maybe I should make this, put a little wings on it so that you know that that's a capital V. This is a little v. And so this is the value of a futures contract that at time t, this is the value, and then this is the expiration, capital T. Okay? And as we go through the chapter, I'll cover more notation. But that's what you need to know for now. And so before we actually get into pricing, so this is a forward price, this is a futures price, and this is value. The value to somebody who actually entered into a contract. So remember, you enter into the contract to buy, you're going long, or you enter into a contract you short, means you're selling, and then you're going to sell in the future. So you enter into the contract now to sell it in the future. Okay? Now, remember from accounting class, you have realized gains and losses, and then you have unrealized gains and losses. Realized gains and losses, like let's explore that with a stock. You can wrap our heads around it a little easier with a stock. So you have a realized gain or loss when you actually sell and get out of the position. So if you go long and you sell the stock, you don't have a position anymore in the stock. You realize the gain or a loss, and at that point you have the cash flow to be able to pay your taxes. So if you make a gain, you'll have the cash flow to be able to pay your taxes. And if you have a loss, well, then you lost some money. You might be able to get some tax benefits from that, some deductions from it. So the realized gains and losses is when things actually materialize. Unrealized gains and losses are when you buy a stock, for example, and you haven't sold it. So you bought a stock for $100, it's now $125. You have a $125 unrealized gain on that stock, and if you decide to sell it, then you will have a realized gain for $25. Okay, so the reason why we're making this distinction here is because futures contracts are marked to market on a daily basis, and we saw that in chapter 2 when we did a specific example of mark to market transactions. And when you mark the market, there's variation margin requirements. So when contracts start going against you, you have to deposit money into an account for deposit for margin. That variation margin payments basically means that you take a contract that's unrealized in a sense and you turn it into a realized gain or loss. So if you didn't have margin requirements, like you do with futures contracts, if you did not have margin requirements, then you'd have realized gains and losses over the life of the contract. So you'd enter into the contract at time zero, and then at capital T, then the contract matures. You would realize the entire gain at this point in time. But when you have variation margin, you're going to realize the gain or loss at the end of each and every day up through expiration. And so futures contracts, all these variation margin payments are being made, and it becomes basically a realized gains and losses. So that way, any big losses that take place, the big loss that you may incur gets recorded, and you have to put margin up each and every period. That prevents major losses and the domino effect that if you enter into a contract at time zero and you lose a ton of money, and by time T, you may not be able to pay pay off this contract and be able to settle the contract, and so the counterparty is at risk. And if the counterparty is at risk, then that means the entire system, financial system, may be at risk. And so that's why we have those margin requirements. So that's kind of a summary of what we did in Chapter 2. Now, forward contracts don't have this margin requirement. So it's a cumulative gain or loss that you end up realizing at time T. So when the contract matures, it could be a huge gain or a huge loss that you end up realizing at that point. Now, if it's a huge loss, hopefully you have the cash to be able to pay off that huge loss. And that would end up obviously being a gain to the other party on the other side of the transaction. So now let's look at, before we go any further, let's look at the convergence principle. And this is an important principle. And that's the convergence principle. Convergence means what happens at capital T, with contracts. And so at expiration, forward and futures contracts, mechanically, if you ignore margin requirements, forwards and futures are almost identical in the way they operate, mechanically, the way they work. And so at time T, at expiration, and you're all done, so to speak, with margin requirements and settling up in variation margin, then you get this idea of convergence, the convergence principle. And it's really important. It's not very hard to grasp, but it's important later on to help us secure these contracts. So let me write this down. For a forward contract, let's say we created, now this is hypothetical now, we create a forward contract right here, right at the time of expiration. We create a forward contract. So that's what that says right there. And it matures at the same point in time. Okay? That value, so the price, what is the price of this contract that we right here create? Okay? That's going to be the spot price at time T. That's the value, because remember, what can the forward do for you? Well, if you enter into the forward to go long, you're going to be able to buy the spot at this price, right? Because the contract at this point in time flips into the spot. So the forward price for a contract created at expiration is the spot. And the futures price for, hypothetically, a futures contract created at expiration that matures time capital T is the spot itself. So you can ask yourself, well, how can you know that? Well, think about it. If you were to enter into a contract right here, and let's say the spot right here is $100, right? $100. And you're like a split second before you enter this contract, what must be the forward, or we could put a little f here for the futures price? Well, if it was 110, well, what would you do there? Well, you would end up shorting the forward or futures, right, and sell it at 110, and then the next second you'd be able to fulfill that contract by buying the spot at 100 and immediately and at the same time selling it for 110. Well, that doesn't make sense. That's an arbitrage opportunity. So it can't be 105, it can't be 101. It means the forward price is going to have to be exactly equal to 100 so that there's no arbitrage opportunities there. Now, the forward price can't be below 100 either, because then you would be able to buy the spot, carry it, and be able to sell the forward or futures at time t. So it boils down to the fact that at expiration, the spot price has to equal the forward or futures contract price. Okay, now another concept that pops up is the notion of basis. And basis is the difference between the spot price and the forward or futures price. Okay, that's how your authors define it. Sometimes some authors define it by flipping this around. So the spot is over here and the forward or futures is on the left side here, is in place of the spot. But we're going to define it as the basis is the difference between the spot price, right today, times 0, minus the futures price. Let's say, let's call it a futures. Let's just do the futures here. At time 0 that matures at time t. Okay, that's important. This difference between the two prices, which is known as basis, it sometimes varies. It sometimes moves around. It's not constant, and we'll be exploring that later on. Now, page 3 of my notes, it talks about value. And so this is an interesting area. A lot of textbooks you see on this and material you see on futures and forwards, you don't see putting value and price under a microscope to see if you can differentiate it. Because you can actually get through a whole lot of this chapter without understanding that. But the point is, there's an important element here. If you understand what we're doing and what the text is doing and what I'll be doing here when I talk about value at different points in time versus price, you'll have a much better understanding. But it comes with a little bit of cost. You're going to have to think about this for a bit. Okay, so what I want to do is we're going to look at value. The value of a futures or forward, and we're going to look at both forwards and futures and compare and contrast. And the main difference between the two, the source of the difference, has to do with mark-to-market and the variation margin that's associated with it. So if we look at here a contract, I'm going to build a little table like it's in the notes. We're going to look at 3 time periods. And the time periods basically correspond to, look, like I showed you before, we start off at time 0, t equals time t, or 0. Then you have some intermediate time, and then you have expiration. Okay, so we want to look at pricing and value at this point in time, at this interval of time, and this point in time. And so that's what these 3 columns represent here. So we're going to look at a long forward, and we're going to look at a long futures. Okay? And so think of time t equals 0 as being inception. At the inception when the futures or forward contract is first created. The value of these contracts at time 0 for a contract that's been started at time 0 and expires at time t is equal to 0. The value of the contract. And so what does that mean? Well, this means, look, you enter into a forward contract. It has a forward price. So if it's corn, for example, you've entered into a contract to buy corn. and it's going to mature at time t, right? And so you've entered in to buy it at a futures price. It could be $4 a bushel, right? But you're locked in to pay $4 a bushel in the future. What is the value of what you expect to get? Well, the present value of that corn is worth $4. So in other words, the value of what you expect to pay at this point in time, right? The value that what you expect to pay here, the present value of that, and the cost that you're going to pay here, the present value of those two things are equal. So what you expect to receive and what you expect to pay are equal. That's what determines the price, that $4 price for the corn. So that's what this is saying is, at inception, when you first enter a forward or a futures contract, when you in this case, a forward contract, when you first enter that, the value is 0 because what you expect to get and what you expect to pay will be equal. Okay? Now, with a futures contract, the same thing holds. Futures contract created at time t, expires at capital T. The value of that contract is 0 because the value of what you're going to get versus what you're going to pay is equal. Now, at some intermediate point in time, for example, with the forward and futures, things may change. You're going to end up with a gain or a loss in most cases because you've locked in to pay a certain price at expiration. And you've locked in to pay that price, but that underlying commodity is gyrating up and down over time. So you lock in a price of $4 for corn right now. Well, 10 minutes later, the price of corn for delivery at time t is going to change a bit. So you're going to have realized gains and losses as you go through time. And so here, let me spell it out a little bit bigger right here. I'm running out of space. And so the value of a forward contract at some time, intermediate time t, that was created at time 0 and matures at capital T is equal to the spot. This is the value of what you're getting. There's implicitly a positive sign here, but nobody writes out the positive sign, right? And then you're going to minus out and subtract out the present value of the futures price that you're going to pay. So remember, we're going long here, which means we're going to buy, and that's why we have a negative sign. We're going to pay this amount, right? And we need the present value of that amount. Oops. So we need to discount this back by a risk-free rate, and we'll talk about that in a little bit. So that's the interest rate, so that shouldn't be a surprise to you. And we're going to discount it over t, capital T minus little t. So in other words, if we're valuing it right here at time t, then cap t minus t, capital T minus little t, is this distance in time. And we're going to discount it back by that amount of time, this interest rate at this amount of time. And so this is the present value of what you expect to get. You know, the spot is the present value, spot today, right now at time t. It's what you expect to get minus the present value of what you expect to pay. This is your cumulative gain or loss on a forward contract. I say cumulative because there's no mark-to-market on a forward contract. Then at expiration, the value, let's do the forward contract, at expiration, capital T here, for a contract that was created at time 0, is equal, here's your cumulative gain and loss, ST minus, see, there's no discounting at this point because we're right at expiration. You're right at expiration. There's no time left, so there's no time to discount. So there's no discounting effect of dividing it by 1 plus R. So this difference is your cumulative gain or loss over the entire time you owned the contracts. So that's your cumulative gain or loss. And remember, that cumulative gain or loss, this could be a huge loss. And so that means there's a lot of counterparty risk on the other side. Because if you fail to pay off, then the counterparty is stuck with the contract. And so your failing to fulfill the contract could cause the counterparty to fail. And that could cause a domino effect. Well, futures contracts, if you recall, with the mark-to-market are designed to prevent that domino effect. And so if we look at, let's look at futures contracts here that are not subject to mark-to-market. The futures contract here is the value, and this is a little v, the value at time t for a contract that matures at capital T, okay, is the futures price at time little t, right, minus the futures price that happened yesterday, so to speak. So t minus 1, if we look at this in days, this is the futures price the day before. Okay, we're counting t in terms of days here. And so this right here, this difference, represents the gain or loss for a single day. So the previous day, there was a mark-to-market, there was variation margin paid, things settled up at that point. And as soon as you settle up, that instant you settle up, then there's the value of the contract is technically zero at that point. And then as time goes on the next day, this futures price is going to change. You're going to have a gain or loss, and this is a gain or loss for a day right here. And that is the value of your contract. The value of a futures contract really represents the fact that it hasn't been marked to market since the day before. And the value is this gain or loss for just the day. And then the value here at time t, let me see if I can write it down below here, is the value at time t is capital T here is equal to the futures price at expiration, that's a futures price at expiration for contract matures at capital T, minus the futures price from the day before. Again, so that's consistent. So the value here, so these values will be very little because you've already realized the gain or loss in previous days. As I showed here, you previously realized those gains and losses all the way through. Okay. So what that does, you know, why did we go through this exercise? Well, it really helps to clarify what should show up on your balance sheet and where, so to speak. So you have a futures price or a forwards price, and then you enter the contract. And when you enter the contract, it has zero effect technically on your total balance sheet. Because when you enter the contract, what you expect to pay and what you expect to receive equal. So you may have a liability and you may have a receivable. The net effect is zero at that point. But as time goes on, you're going to recognize gains and losses. That's going to show up on your income statement, those gains and losses. And those gains and losses show up on your balance sheet to the point where your receivables and your payables don't equal. And they don't equal by the cumulative gain or loss in your income statement. You got to remember, you know, go back to your basic accounting concepts. Okay. Now, that said, let's move on to pricing. Determining the price. So this is the price right here of a forward. This is the price of a futures contract. So how are these prices determined? This is what we want to do. So this is akin to, you know, when we dealt with options. For a while, when we dealt with options, we just took at face value. This is the option premium. This is the price of the option. But now we're at a point where let's develop and show a model that explains where these prices come from. They don't come from thin air. Traders just don't, you know, the price doesn't come from the sky and traders start trading. Somebody determines what those values are. And that's what we're going to try to explain. So keep in mind, maybe I should have said this when I first started the chapter, but keep in mind when you enter forwards and futures, There's no premium associated with these contracts. They're not like options. Options, you pay a premium. When you enter a forward contract or a futures contract, you're obligated to fulfill the contract, and there's no premium to charge at first. And so you have to keep that, try to keep that straight. And that's one of the hard parts about teaching options first and then going into forward and futures, is you're so wired to options contracts that when you get the forwards and futures, which are not quite as bad as technical, you got to rewire your brain a little bit to figure them out. I've taught in textbooks where we cover futures and forwards first, and then we get into options, and basically the same thing happens. You get hardwired with forwards and futures, and then you're asked to start thinking in terms of options, and it's hard to rewire your brain on that. That said, we covered options. You're pretty well hardwired. Now I'm going to ask you to flip around and rewire your brain a bit to forwards and futures. But at the end of this chapter, we're going to look at futures options. So that's that makes it even harder. So not to worry. Typically, over the years, when I do futures options, it's usually as an extra credit. If it shows up on an exam or a quiz, it's an extra credit. It's extra credit material for the actual valuing of those things. There might be some easy concepts that don't involve valuing that could show up on a quiz or an exam. But in terms of calculating a futures options, which is an option like a call option on a futures contract, that's extra credit typically. Okay, so let's go to pricing. And let me boil it down. Let me get right to the chase, as they say in the notes. Boil it down. And by the way, we're going to stick from this point on. Most of what I'm going to talk about is futures contracts. Because I said once you get past the idea of margin, and you ignore margin, which is what we're going to do to make things simple, we ignore margin, then there's really mechanically no difference between forward and futures contracts for the most part. In which case, we're just going to look at futures contracts. It's just simpler. So here we're going to look at, boil everything down. This is the workhorse model of futures pricing. And it says the futures price today for a contract that matures at time t is the spot times 1 plus r to the t power. And you might, and you don't have to do this because it doesn't do anything mathematically, say it's t minus 0 because you started the contract at time t, and so that doesn't really do anything for you. So we just say through time t. So this is the workhorse model, and this is pricing through cash and carry model. This is the workhorse model of futures contracts. So when we did options, we did the binomial, and then we did the Black-Scholes model. Those two models are the workhorse models of options. This is the workhorse model for futures contracts. Okay? And so the concept of cash to carry is very intuitive, and it's probably best to develop this formula, okay, with this equal sign, through an example, a couple of examples, and I'll show you how this formula comes about. So the example I have on page 5 of my notes says, suppose the futures price of corn for 1 year delivery is $8 a bushel. Okay, so the futures price is $8. Now you don't, like I said, at this point, you don't have to be so technical about it. You don't really need to know the subscript and the T. You can almost make it just little f, and a lot of textbooks do that. The simple introductory textbooks will do that. But your textbook author is carrying the notation on. I'll continue it. So the futures price is $8, and it says while the spot price of corn price today of corn is $7 a bushel. Okay, so corn is measured in bushels. The repo or the T-bill rate is 3%. Okay, now the question is, if you were a savvy futures trader in a perfect market, meaning we're ignoring transactions costs and we're ignoring all other costs except the fact that there's an opportunity cost of money at 3%. So we're ignoring all other costs to keep it simple. How can you take advantage of this situation, given what I have here? Well, if you thought about it, why don't I buy corn in the spot? Buy spot corn for $7 today. Okay, so I'm going to buy it at $7. I'm going to give up $7. Okay, and why don't I simultaneously sell the corn for $8 in the futures market? Okay, $8 in the futures market. Get that on there. Okay. Now, but wait, if I buy the corn now, I have to carry that corn, and that's where the cash and carry. I'm paying cash in the spot market, and I'm going to carry it the entire year. So this is 1 year. Well, that's going to cost me because my money is tied up. $7 is tied up. That's at an interest rate of 3%. So my total cost at the end of 1 year is $7.21. That's my total cost. But at this point in time, what I just did was I bought the spot, carried it, and I sold the futures contract simultaneously. So I have no risk. So we're ignoring any possibility of, you're taking this corn, you have to put it somewhere, like in a silo. We're not worrying about the fact that the silo can burn down or collapse or something could happen to it. We're just ignoring that and just covering the opportunity cost of money for simplicity. For the moment, we'll bring in other costs shortly. Then what we have is we have a 79-cent profit per bushel in this contract. Risk-free, because we kind of assumed away the risk in a sense. And it's risk-free because we bought the corn, we're going to carry it, and we locked in a selling price. And so that is called cash and carry, financing costs only. Now, if we assume that futures traders will exploit any cash and carry opportunities, then we establish an upper bound on futures prices. Okay, and that upper bound is this. That is the upper bound right here. Okay, and what that says is to prevent cash and carry profits. Okay, to prevent cash and carry profits, the futures price must be at or below the cost of carrying the item from buying it in the spot and carrying it over the 1 year. So to prevent this profit, to prevent these profits, the futures price has to be below this cost. So the futures price has to be at $7.21 or less to prevent this cash and carry from being profitable. Okay, so that establishes an upper bound. Okay, now what we want to do is let's establish a lower bound and then compare it ultimately to the formula. That this is how things just simply, it boils down to this formula. But let me show you how to get there by doing what's called a reverse cash and carry. Okay, and the best way to cover reverse cash and carry is through an example. And so let's say futures price of corn for 1 year delivery is $5 a bushel. Okay, and the spot price of corn right now is $7 a bushel. The repo rate or the T-bill rate is 3%. Again, if you were a savvy futures trader in a perfect market, this is the only costs you have, there's no risk else involved. How could you make this, how could you make a riskless profit from this transaction? Well, you're looking at this high price, and you know the golden rule is you sell what's high. And so what if we short corn in the spot? So we sell corn in the spot for $7. Okay. We invest the proceeds at 3% for 1 year, and our proceeds end up being $7.21. That includes interest income of 21 cents, okay, from the corn. So our total proceeds are $7.21 overall. But the cost when this contract expires is going to be $5. So we end up making $2.21 a bushel on this situation. Well, that can't be in an efficient market. So what this does is what we're establishing here is the futures price, right, has to be greater than or equal to the cost to carry. Okay, well this is the futures price here. Okay, the futures price here has to be greater than or equal to this price. So let me write it out here. Okay, this is a lower bound. Okay, and what it says is to prevent a reverse cash and carry strategy, to prevent this type of profit. Okay, the futures price must be at the cost or more from the proceeds of selling the spot and investing it. Okay, so the futures price has to be this price or more, and that is the lower bound. So what we just did is this. We have a lower bound here, and we have an upper bound here. Okay, and so basically what we did, if you put a line out, the real line here, and we plot it down, the lower bound basically says it's 721 in the example or greater. Right, 721 or that price, because there's half an equal sign associated. It's that price or greater. So this is the lower bound, and the upper bound says the futures price has to be 721 or less. Okay, so if you're hitting 721 here on the upper and the lower bound, it boils down to a specific $7.21. So what I'm saying is, the greater than or less than signs, they disappear, and it boils down to an equal sign. There's the equal sign. And so 721 equals $7 compounded at 3% for 1 year at 721. So that is the exact price under cash and carry model. So the cash and carry model relies on no arbitrage opportunities under cash and carry, no arbitrage opportunities on reverse cash and carry. Now you might ask, and that's an interesting question, well wait a second now, how could, when the reverse cash and carry, we shorted spot corn. Let's think, how do you short spot corn? How can you? It basically means you have to go into the market somewhere and have somebody lend you bushels of corn for you to sell so that you can sell them and then buy them back at a future date. And so the question becomes, well, how can this model really work? Because reverse cash and carry is, it's a nice thought experiment, but can you really do it? And the answer is yes, there is a way to do it. And the way to do it is most businesses that deal in corn, for example, farmers, Kellogg's, Post, bread makers that may use corn, bakers, they have inventories of corn, and they can short corn by reducing their inventory, which means selling their corn inventory that they hold and buying it back and getting back to their long run inventory levels at a later point in time. So yes, there can be reverse cash and carry strategies out there for businesses. So there you have it, the cash and carry model. Now, one thing you got to remember is that under the cash and carry model, you have to be able to carry the underlying. And so the example, the common example about some of the issues with cash and carry is, what if you have, for example, vine ripe tomatoes, tomatoes that are really ripe. You can't really store them very long, so you really can't really apply the cash and carry model to vine ripe tomatoes. And you can't really use a cash and carry model for weather futures, for example. Weather futures, yeah, believe it or not, there are weather futures contracts that are, basically farmers and other big ag companies are betting on the amount of rainfall, the amount of sunshine, or maybe the average temperature in an area, where obviously you can't carry and store weather, and you can't, in terms of rainfall or temperature. So there are other models. We'll get to that a little later. So keep that in mind. Cash and carry model works best when you have commodities. Could be corn, wheat, and it could be, like the oils and metals are all things that can be carried and reverse cash and carried for the most part. And that's when this cash and carry model works. Now let's talk a little bit about storage costs. In reality, there's more than just financing costs, and we covered financing costs with R here, with R in the model. But obviously, if you're buying something and you're storing it, then what you have to worry about is, well, there's costs such as inventory, warehousing, insurance, which makes a lot of sense, insurance, because you want to insure the underlying commodity so that you have that commodity 1 year from now and you're not at risk. And so when you have it insured, then you can use this little R. So if we introduce risk into the model, that's great. We can still use this little R for the financing costs because we have it insured. Now, the textbook throws all other carrying costs, such as warehousing costs, insurance, even transportation, throws it all into a variable, little s. You can see here, little s. That's a little s, and that's measured in dollars. Okay? Now, let's do an example. A cash and carry example like we did above, so that we can show how to embed costs into these. So suppose spot price of corn is let's see, $7. Okay, spot price is $7. Storage costs, denoted as little s, is 35 cents per bushel. Okay, the repo rate is 3%. Okay, and now what should be the 1 year futures price? The 1 year futures price should be, okay, for 1 year, T equals 1 year. So it expires, just another way of writing that out. Just to be clear that T is 1 year, it's going to be the $7 times the 3%, 1 plus the 3%, right, plus the 35 cents. and that is $7.56. So when you start adding costs, the futures price here for no arbitrage opportunities would be $7.56. Okay. Okay, let's look at stock index futures. And when I say look at stock index futures, what I mean is let's apply the cash and carry model to stock index futures, because the stock index futures are perfect application of cash and carry and reverse cash and carry. Now, obviously, from a cash and carry perspective, it's obvious that you can use stock indexes, index futures contracts on this, because you can carry an inventory of stocks, or the stock index. That's what they're designed to do. The only little twist in the story is that there's dividend yields that are associated with holding stock. So when you hold the stock, it's kind of like a negative storage cost. So when you buy corn and you put it in the silo, there's going to be some costs associated with holding that corn. That's costs. Corn doesn't actually generate a yield or cash inflow of any sort, but a stock portfolio will. So you buy a portfolio of stocks or a stock index, it's going to generate dividends. So we need to reflect that in our model. So the futures price today will equal the cost of carry, like we're used to seeing. Okay, that formula, carrying, so because we have to tie our money up to invest in the stock market, and that's what the R is reflecting, the cost of money. But then we generate minus, so we generate dividends, which is an offset to the cost of carry. And so we look at the dividends that are generated over the life of the contract. So from time 0 through the life of the contract, these are the dividends. Okay. Now, what we have here is this term is measured in dollars, this term is measured in dollars, this term is measured in dollars. It all makes sense. There is another way to rewrite this formula so that you can put dividends not in dollar form, but in a percent form. And so the way to do that is the formula would be this. And this formula that I'm writing out here is more common in the literature. And it's where we calculate a dividend yield. And the dividend yield is nothing but the dividends in dollars, right, from this time period here, divided by the spot price. And that's the dividend yield. Okay? So now, going back to the cash and carry, so obviously when you do a cash and carry, the dividend will reduce the cost of carrying, and so it'll change the futures price. The other thing you want to keep in mind is that reverse cash and carry works the other way, that when you short sell something, keep in mind that you owe the dividend. So when you short sell an index, you'll receive R, right? But then you're going to have to pay the dividend, and so it's going to add to your costs when you do a short sell. Let's do an example, and it's at the bottom of my notes on page 7 or thereabouts in your notes. Suppose the S&P 500 is at 2,500. Well, that sounds like the spot price, right? So the spot price is 2,500, and the risk-free rate is 2%, or 0.02, and the dividend yield on the index is $50. Okay, so that's going to be $50, which is 2%, which is 2% of the 2,500. Okay, and so the contracts, as it tells us, are 1-year contracts. So there's a 1 here. And so what we see is the futures price is equal to the spot price, exactly. And the reason for that is the cost of carrying it, that opportunity cost, is 2%. But you're also generating 2% from the dividend yield, so the cost of carry net effect is 0. And so that's why the futures price and the spot price are the same in this example. So that's a nice example. And we could rewrite this in terms of this formula with the dividend yield, and this would be 2,500 times 1 plus the 2% R minus the dividend yield for 1 year, and we get 2,500 again, also just in a percent form. Let's do another example that will help us establish ways to deal, examining and taking advantage of mispricing of securities in stock indexes, being specific here. Mispricing of securities and how arbitrage forces these relationships to work. So let's do an example. And the examples on my notes are at the top of page 8. So we have an example here. It says, consider a 4-year futures contract on the S&P. The S&P 500, let's write it down, is 3,000 now, so that's a spot, and its dividend yield is 1.7%. And so that's on an annual basis, by the way. So when you see a dividend yield announced or disclosed somewhere, it's usually on an annual basis. And if it says nothing, there's no clarification, it's on an annual basis. And so the risk-free rate going further here is 1%, and 4-month S&P 500 stock index futures are trading for $3,010. Now, part A of my question, it says, look, the futures are mispriced, but are they over or undervalued, and by how much? Well, let's work the formula. Okay, the opportunity cost is 1% on an annual basis, 1.7% dividend yield on an annual basis. It's 4 to the 12th power because we're only dealing with 4 to 12 months. And so therefore, the futures price here should be $29,992.98. Okay? And this is one way to write it out, by the way. And so you get $29,992.98. You can technically write it out another way. You'll get a slightly different result, and it's the way we do the math. And I think this math that I'm about to show you will is more consistent with the procedures I'm going to show you in a second. So you can think of this as, look, the cost to carry is 1% for 4/12 of a year, and then look, you have to subtract out the dividend yield for 4/12 of a year, and when you get done, you get $29.92.81, and so wow, 17-cent difference. Not very much of a difference there, but it's just a difference in how you calculate the numbers, and how you calculate the numbers depends on the methodology for the arbitrage situation and how to derive it. And I'll show you that in part B here in a second. It's only 17 cents, so you can basically say, look, we're going to lose this in rounding. 17 cents on nearly $3,000 is pretty small. Okay, so now the question is part B, and this is hard. This is a hard setup, and it kind of will remind you of what we did back in chapter 3 when we did boundary conditions. How to derive an arbitrage strategy to take advantage of the mispricing so that there's no initial outlay. So remember, that's one of the rules, no initial outlay. And all dividends from carrying the index are immediately reinvested back into the index. And so you can actually do that, by the way. If you're not familiar with investing and you buy stocks or stock indexes, your broker will ask you, do you want the cash? Do you want dividends to be immediately reinvested? And you click a little box and you say yes, because you don't want the dividends to be sitting there in cash. It won't earn hardly anything if interest rates are low. So you're almost always better off just reinvesting those dividends, especially true when you talk about mutual funds. So that's a little side note here. So let's continue with the problem. Derive an arbitrage strategy to take advantage of this situation. So I'm going to give you the recipe, and you would have to work a long time to figure this out. But just follow along and see if you can grab the intuition here. So the first thing we want to do, let me start with a clean piece of paper here, is first thing is we are going to short Oh, and by the way, before I even go further, let's answer the question of Part A. Are the futures over or undervalued? Well, the futures contracts are trading in the market at 3,010, and we estimated that the futures value should be 29.92 and change. So therefore, the futures price that's trading on the market is overvalued. Okay, it's overpriced. And when things are overpriced, remember the golden rule, you short, and that's where I am here. You're going to short one share of the futures. And that will be for $3,010. Okay, short one share of the futures. Back this out a little bit more so you can see better. Okay, there we go. Now, the second step will be buy. Now, here's a tricky part. Buy 1 minus d to the t power shares of the spot. So that means the spot is at 3,000, and you don't want to buy one share, because that would be one share at 3,000. What you want to do is we want to buy 1 minus d to the 4/12. What we want to do is actually buy 2982.90 shares. We don't, or I shouldn't say shares. We want to buy this much of the stock index. Okay, just less than one share is really what we're buying here. Buying just less than one share, because what happens is this amount right here, this 2982, this amount will grow to 3,000 in 4 months. It'll grow because we're going to constantly reinvest the dividends. So we're going to buy this much, a fraction of a share. It's, like somewhere around what, 98, 99% of a share. And this will grow to $3,000 if we continuously reinvest the dividends. Okay? So what it means is we end up with one share at the end. So we bought a fraction of a share, that's like 98 or 99% of a share, and it'll grow to one share in 4 months. Now, if we have to buy this, we need to finance it somehow. So we either borrow the money or we have to consider the opportunity cost. So let's say we just borrow the money. We borrow $2982.90 for 4 months. Okay, at 1%. Okay, and so that's the borrowing. So this is inflow at time t, by the way. So inflow time t, or time t equals 0. You can think about it. It's now that we're doing this. Now at maturity, the maturity of the futures, the cash flow is 3010 from the futures. Because remember, we shorted a futures contract, which means we have to deliver the underlying index, and we're going to get cash flow. Okay, this is inflow at time t, capital T, inflow at time t. Okay, now step number 5 is, step 5 of the recipe, so to speak, is you deliver one share of the index, okay, which is now worth $3,000. Okay, so there you have it right here. This 2982 grew, remember, grew through dividends, grew to $3,000. Okay, now now part 6. So you just fulfilled the contract, the futures contract that you were obligated to do. Now what you do is you repay the borrowing. At 2982, this is what we borrowed, times the 1% for 4 months, and we repay 2992.81. Okay, so this is outflow when we repay. Okay, that was outflow. And by the way, this was outflow at time little t, and this is outflow at time capital T. So when you net these cash flows together here, what we're left with is a profit of 3010 minus the 2992.81, this number right here. And we end up with $17.19. The $17.19 is exactly the difference between the futures price that traded in the futures market and what we estimated it to be using the cash and carry model. So we captured this difference. See, these numbers should have been the same in an efficient market, but they were not. The futures were overvalued, and when overvalued, if we do things right with no investment down and no risk, we should be able to capture that profit of $17.19, and that's exactly what we did in the example. So I think the hardest part is recognizing that you can reinvest dividends, and you buy less than the amount of one share because of that. So part two of the recipe here was probably the tricky part, but it's insightful. Okay, now moving on. What we want to move on to now are other models of futures prices. Other models. And so we just got done looking at the workhorse of futures pricing. But you know, as we talked about earlier, it doesn't always work that well because you can't always carry the underlying. If they're vine ripe tomatoes, you're looking at weather futures. So that leads people to look at other methods of trying to come up with, what drives futures prices. And that's where we are here. So what we want to do is look at futures prices and then try to back into what drives them. And what we think drives them, and it makes a lot of sense, is that, look, you enter into a futures contract today, you have in mind an expected future spot price. So if you buy corn and the futures price is $4 right now, and the contract matures in 1 year, you have in mind that, there must be, what will be the futures price 1 year from now. So if you move the calendar up and you're 1 year later and you're sitting there, it's like, what is the spot price at that point? Well, from now perspective, it's it's the expected spot price 1 year from now. And so that's one reasoning. That's how we're approaching one of these other models. And so let's look at let's derive this model so it makes sense from the ground up. And that's what we're going to do here. So let's consider a speculator who takes a long position in a futures contract that matures in capital T years. Okay, now we have to consider the opportunity cost of money. And so when the contract matures, the investor will have the money from this account to take delivery of the commodity. So when you enter into a futures contract and you go long, and that's what we're doing in this example, we're going to go long in this derivation. And if we go long a futures contract, we need to have the cash available to take possession of the underlying, because that's our obligation, is to buy that in the future. So let's deposit today an amount equal to the present value of the futures price that we're going to have to pay in the future. And so we're going to deposit that into a bank account. So we're going to deposit it, means kind of we're giving money up, depositing money in the bank. We're giving money, taking it out of our pocket, putting it in some account somewhere. And we're going to take, and how much we're going to put in there is not the futures paying, the futures price that we're going to have to pay at time t, but we need to calculate the present value. What is it worth today? And so we're going to deposit this amount into an account. Okay. Now, you have in mind, like I said, 1 year from now, or I'm using 1 year. Let's time t, capital T, is you have this expected spot price, and so let's say we take the present value today of the expected proceeds at time t. So what's going to happen is you're going to go long right now. You're going to go long a futures contract. When the contract expires, you're going to give up. You're going to have to pay the futures price, but you're going to get in return, you're going to get the value of the commodity, the underlying. You go get that value, and we're going to assume that you sell it. So that's probably conceptually the best way, but you have this value. And so what is that value worth today? Well, you have an expectation of what the spot price will be. You don't know quite what it will be, but you're going to wrap this expectation as an operator, is what it's called, around the spot at expiration. And then since you don't know what the spot price will be, we're going to discount it by 1 plus I to the t power. This I includes not only the opportunity cost of money R, but also reflects a risk premium, plus a risk premium. Okay, which I'll explain in a second here. But think of it this way. Here's your timeline. Here's time t. So you're entering into the futures contract here. The contract matures here. And you know for sure that you're going to have to pay this futures price here. So there's no uncertainty around it, which is why we're discounting it at the risk-free rate. But what is the value of the commodity that you're going to get 1 year? What is the actual price of corn 1 year from now? What is the actual price of oil 1 year from now? You don't know. So basically at this point in time, if you want it, you can think of it this way. There's a distribution around where it'll be. And that distribution means that there's risk. It could be low, it could be high, it could be anywhere on here, but you expect it to be here on average. Oops. You expect it to be here on average. Expected spot right here. So that's like a weighted average of whatever you expect it to be. Think of it just a normal distribution I turned on its side. Okay? So that's the setup. Now let's go a little further. So now, given the risk of this transaction and the investor's degree of risk aversion, what is the minimum rate of return the investor will demand on this situation? Well, the minimum rate is where you break even. So the futures price at its present value, okay, which is what you're going to pay to take delivery, but you're going to receive something, and what do you expect to receive? You expect to get this, but it's risky. So as of today, you're going to discount that at rate I because it's quite risky, and so this is the present value of that expected spot. That has to equal 0. So this is where you break even, basically. Okay. And so if we rearrange this mathematically, just algebra, we get a futures price equal to the expected spot divided by 1 plus I divided by 1 plus R to the t power. So that's a little bit of an exercise for you, practice to be able to flip this formula and convert it into, trying to get, remember the goal here is futures prices. So the future price equals what? The expected spot rate discounted by this risk premium. And that's what's in the brackets here, is basically the risk premium is what's in the big bracket here. Okay? Some people simplify this down because they don't like this division by division. And so if interest rates are low, you can just experiment with this on your calculator. If interest rates are low, then 1 plus I divided by 1 plus R is approximately equal to 1 plus I minus R. So you can play with that. Just run some examples when interest rates are low, and you'll see that that's a reasonably good approximation. Okay, so therefore futures prices today are approximately equal to the expected spot price discounted by 1 plus I minus R to the T. So what you're seeing here is this, what it boils down to. The futures price today is equal to the expected spot price minus a risk premium. And your book denotes the risk premium as such. Okay? So what we're saying is, look, this futures price depends on what the spot is expected to be minus a risk premium. And what's the source of the risk premium? That's important to know. Where did this risk premium come from? That risk premium came from the fact that we don't know exactly where the spot will be in the future. It's somewhere along this curve, if we assume a normal distribution. And so you can see that that risk, the risk associated with the spot price, gets translated into the futures price. Okay? So that's where this risk premium affects the futures price. And the source of it is we don't know exactly what the futures price will be, or the spot price will be in the future. You can rearrange this, and obviously this is a simple rearrangement. Just another way to write it in saying that, look, the expected spot price in the future at time t is equal to the futures price plus the risk premium. Just rearranging this formula. Okay, so let's do an example. And I'm at the bottom of page 10 of my notes. Suppose that the futures price of silver for 1 year delivery is $40 an ounce. And the risk-free rate is 3%, and the risk premium for silver is 10.3%, given how volatile silver prices are, and the investor's degree of risk aversion. Okay? So what is the expected future spot price for silver 1 year from now? Okay? Let's do it. Let's do it. What is the expected price? Well, let's do the formula, and we're going to use, let's go back and actually use, to be more precise, this is the more precise formula. Right? So we'll start out with that. And which is, you can approximate it with the other formulas here, but let's do the more precise. So we have the futures price is $40. We're asked what is the expected spot price, so that's in symbol form because that's what we're being asked to solve for. We know that the I is made up of the risk-free rate plus the risk premium. And we divide it by the risk-free rate. Okay? And so when you do the math, that implies the expected spot is $44. And so the expected spot equals the futures price plus $4 associated with the risk premium in this case. So all I did was I'm using this formula at this point. So the expected spot is the futures price plus the $4 premium that's associated with how volatile silver prices are and the degree of risk aversion, how afraid people are of that risk at that point in time. Okay. Now let's do another example. This is an interesting example because you probably don't know much about class 3 fluid milk, but there is such a beast out there. So let me go over it. Let's assume that you're interested in speculating in class 3 fluid milk futures. Class 3 fluid milk futures are known as cheese milk, and it's the primary ingredient of cheddar cheese. The contracts are extremely volatile. If you look at the CME, remember the Chicago Mercantile Exchange, they have a publication on every futures contract out there that they have, because it's part of their marketing and selling. And if you read that publication, you'll find that the dairy markets are extremely volatile, and small changes in supply and demand have dramatic impacts on price. So what that kind of tells you is, if you remember from economics, somehow the demand curve is really steep for this fluid milk, and the supply curve is steep also. And so when you have steep curves, changes in supply or demand will have a big impact, going up or down here for price. And think about it, on the supply side, when prices gyrate in the short run, there's not going to be much effect on the number of cows and the amount of milk that's produced. And when prices gyrate up and down, people's demand for food products tend not to change too much. And so you have, it's not just people, but intermediaries that use cheddar cheese in their products. So it doesn't change much. So you got steep supply and demand. It's basically the term was used in economics, inelastic supply and demand. A survey of farmers reveals that they expect milk prices, spot milk prices, to rise to 23 cents per pound next year, by the end of the year, because of a reduction in the number of heifer births recently. So there's people that may not realize this, but there's people out there that track the births and deaths of cows and farm animals to try to figure out supply and demand, mainly supply effects on prices. And so that's done. There's reports that are generated for the agricultural department frequently. So your broker suggests that you lock in a price of 15 cents per pound by going long one futures contract. Okay, so people expect the price, the futures, the actual spot price 1 year from now to be 23 cents. The futures contracts are saying 15 cents. So you want to lock in that cheap 15 cents per pound. And by the way, that's how milk is measured on these wholesale levels. They're measured in pounds. And so each contract is 200,000 pounds of milk. I guess it's easier to measure milk in pounds rather than gallons. I guess that's why it's done. And okay, so the contracts expire in 1 year and the repo rate is 3%. Given this information, determine the expected return that's built into the futures market. So you have a futures price, you have an expected spot price that's given to you through a survey of farmers. So what is the return that you hope to get out of this situation? How much profit do you expect in terms of a risk premium? So, well, it's $15 or 15 cents per pound. So I'm going to do everything in cents here. That's the futures price. 23 is the expected futures spot. And we're going to take 1 plus I, just call that X for the moment. And we're going to divide it by 1.03, the risk-free rate. And so what is the return that we expect to get? And that's what this is going to measure. X is going to measure. So if we solve this, you can cross multiply. Remember, cross multiply and set them equal. So there's basically, you're dividing by 1 here. So this is just basic algebra. Cross multiply, you get 15x divided by 1.03 equals 23. Cross multiply and set to equal. And so therefore x equals 1.58 approximately. And so that's the expected return. The expected return is 58%. And the expected return is 58% from that jump in milk prices that's expected to happen. Okay, in an efficient market, that wouldn't happen. I mean, so you gotta. Well, it could. And so let me back up there for a second. Now, if milk prices are that volatile, then dabbling in the market of milk is quite risky. So farmers are quite at risk. So there should be some high risk premiums associated with being involved in that market. And that's what you're seeing here with the 58%. You're seeing a high expected return because the market is quite risky. Had the market been much less risky, those expected returns would be much less. Now let's consider more models, other models that describe the relationship between futures prices, spot prices, expected spot prices, risk premiums, and supply and demand. Whew, all in one. So I'm about to cover some material that's going to sound very much alike. It's going to be confusing in the sense that the language sounds the same and it sounds a little bit strange. But I promise you at the end of this discussion, I will graph out the relationships and they'll make a lot more sense. And you probably could wrap your head around it far better if when you wait for me to put the drawing up, the graph. And I have space in the notes, at least on my copy here, at the bottom of page 12 or around page 12 is where I'll put the graph. And then what I'm saying will make sense. So let's cover what's called the theory of normal backwardization. Don't ask me where the terminology came from. It's been around for a long time. And I'm going to tell you one thing that this may sound strange, but trust me, if you talk to traders in the commodity markets, they will use this terminology all of the time. But you got to be careful. You got to listen to them very carefully as to what they're talking about, so that you can follow what they're doing, because it's a little tricky. So we're going to look at the theory of normal backwardization and just backwardization. Okay, so there's backwardization and then there's normal backwardization. So the theory here begins with, so let me try to unravel this. The theory begins with the idea that hedgers are often short futures contracts. So if you're hedging and you're short futures contracts, that implies you have to be long the spot market, right? Because when you have a long position in the spot market, then you take a short position in the futures contract, which makes sense. So if that is the case, hedgers are often short, then what happens is futures prices get driven down because people sell them. They're shorting futures contracts, and the selling of futures contracts causes the futures prices to go down. Okay, but so futures prices go down at time t right now, but as time marches on and we go from time 0 to time capital T, the futures contracts will as they approach maturity, they'll start to converge, so that futures prices will start to converge to the spot price, and that convergence process is called normal backwardization. Okay, so the convergence process is normal backwardization, and the fact that the futures price is below the spot price is known as backwardization. Okay, so hold off, like I said a minute ago. If that sounds confusing, the graph that I'll show you in a few minutes will make that more clear. Okay, the point is that normal backwardization, this right here, right, is the relationship between futures prices and expected spot prices, okay, between futures prices versus expected spot prices, right? That's what normal backwardization is. And backwardization is all about futures prices today versus the spot price today. Where are they relative to each other? Okay. So what we're saying here is that futures prices are driven low by hedgers who are naturally long. They have to take short positions. It drives the futures price down. Okay. Now, the next idea is called normal contango versus contango. Again, I don't know where this terminology came from, but it's around and it's used a lot by traders. So, it's hard to believe that hedgers are always net short futures positions. It's hard to believe that hedgers are always short. many hedgers go long in the futures market to lock in prices. And we talked about that. There's lots of companies that want to lock in the price of corn or wheat for their production process. And when you do that, you're locking in, you're going long the futures contracts. So what that implies is futures prices are driven up by these hedgers. And so if they're driven up, then what's going to happen is over time, through normal contango, the futures price is going to start converging to the spot price as we go through time here. Okay? And so that process is what normal contango would do. So you can think of normal backwardization and normal contango as a process, right, over time, and think of contango and backwardization as where is the futures price relative to the spot. And what we're saying here is the futures price for contango is the futures price is above the spot, whereas with backwardization, the futures price is less than the spot. Okay. Now I summarized it, the ideas on page 12. And so what I want to do is draw a graph, like I said a minute ago, is draw a graph and then relate this to supply and demand. And then you can see that there's a relationship between the spot, the expected spot, supply and demand, and those differences are what entice speculators into the market, because the differences between a spot price and the futures price implies that there's a risk premium built in there, and that's what can be earned through speculating. So now you can see how spots, expected spots, futures prices, supply and demand, and risk premiums are all tangled up in the one idea. Okay, so let me draw it nice and big. And so what we're looking at here is we're looking at a spot price. Let's start out with a sideways T, but don't put any X in there like we're used to with options. These are not options contracts. So the way to read this is this graph will assume that, look, we have a spot price today right here, a certain amount of dollars, and that we're assuming in this graph, we're going to assume that the spot price and expected spot price remain the same over the life of the contract. So the life of the contract, you think of this as time T going all the way to capital T, time going this way in dollar amounts on the y-axis. So we're going to look at the futures price here. Okay? Now, when the futures price is high, right, relative to the spot, we just defined this as contango. Okay? Because what we said was, we said that hedgers are long futures contracts, and they push, when they long, they're buying the futures contract that pushes the futures price up relative to the spot price. And that's contango. But then we also said, look, there's convergence. And convergence means that over time there's a process where the futures price has to converge to the spot price. It has to. And we also said that, look, the expected spot price has to equal the spot price. It has to equal the futures price. All these numbers must line up. All these numbers must line up at this time T, convergence. And so this process is called normal contango. Okay? And so how do you interpret this? Well, some people, besides just saying the fact that, look, there's hedgers that are long and pushing these futures prices up, some people look at this and say, oh, what this means is that there's excess supply of the spot. And that excess supply of the spot has pushed downward the spot price. So now we're relating this relationship not just between hedgers and people being long the underlying. We're looking at, or short the underlying, and they're going long the futures contract. We're now dragging in the idea that this difference is also driven, can be explained by, it's not necessarily driven by, explained by supply, that excess supply pushing down the spot price. And then eventually things must converge at expiration. Okay? So now that's contango and normal contango. Now, backwardization is when the futures price has been pushed down. So this is backwardization. The futures price has been pushed down relative to the spot. So we said that, look, hedgers are naturally long the spot and they're shorting and pushing down the futures price. Okay, that would explain this relationship here, the spot price being above the futures. But it also could be a measure of a shortage of the spot. Now the spot is short, so the spot price is set high, or in other words, there's low inventory of the spot. All that means the spot price is driven up on shortages, and so it's going to be driven above the futures price in this direction. Okay, but again, eventually things have to converge under the convergence principle that we looked at, and so the process of that convergence is normal backwardization. Okay, and so in this case, cost to carry is negative in this example, and cost to carry here is positive. By the way, it's positive because the futures price is above the spot, and it's negative here because the futures price is below the spot. Just work this formula. Yeah, remember that, the basic formula of cash and carry model. So there you got it. We can look at the relative supply and demand. We can look at these differences, by the way, these differences as representing enticement for speculators to come in. So speculators can go long or short, and whether or not they go long and short depends how far out of whack the spot and the futures price is, because this difference is what the profit they will eventually make, because there will eventually be convergence as we go down towards capital T. So there we have it, backwardization and contango. Now, one more thing that we want to talk about. Sometimes there's one more model to try to explain this, or one more idea to try to explain futures prices, and that's around the idea of convenience yield. And sometimes what people notice in the spot market, in the spot and the futures market, is they notice that futures prices, especially of more distant contracts, so remember what distant contracts are. You got a contract that matures here, that's the nearby contract, and then which may be 1 month from now, and for 2 months from now, you have a more distant contract, T plus 1 month, I guess you could say. And then you could have an even more distant contract and so on. So what people have noticed is empirically that the futures price associated with delivery at time T here is higher than the one here and here. In other words, the futures price actually goes lower. So this futures price is going lower as we go in this direction, further out in time. That flies in the face of this formula, cash and carry, right? Especially with oil, for example, because there's no dividend yield or anything associated with oil, it's just costs. So therefore, the further you go out in time, this T goes up in value. That means the futures price should be even higher. So this futures price should be growing as we go out in time, right, according to this model. But we actually observe periods when oil prices, for example, the futures price declines. Now, you could try to explain that by saying, well, then maybe there's going to be more supply of oil in the future. Well, if there's more supply of oil than you bringing in that idea of supply, that possibly could explain it. But the problem with that explanation is you see it too often, too long, and it's too consistent of a negative relationship between the futures price and more distant contracts. So what people have realized is that there's a convenience yield, especially, for example, with oil. So with oil, there can be disruptions in the supply and demand of oil at any point in time. So when you hold and carry oil, so you're doing a cash and carry and you're holding oil, there is a convenience yield associated with that, because at times there are shortages of oil. And if you're doing a cash and carry and you're holding that, you don't care if there's a shortage of oil because you're holding barrels and barrels of it. And so if there's a temporary shortage, it doesn't affect you. In fact, cash and carry is actually more convenient because you can dip into your supplies if you have to. That's where the concept of convenience yield comes into play. And so the formula for that is this. It's a cash and carry model like we've seen before. Plus, there may be some costs associated with carrying oil, like insurance costs, warehousing costs, and so on. But there's a convenience yield that's denoted as chi, it's a capital chi, that represents a reduction in the cost. And that's because it's convenient to hold oil in a cash and carry situation. And so if this is big enough, and this is associated with time over time, that further out, the more convenience you get, and the more insulated you are against very short-term exposure and shortages, then you can see that since this is a negative sign here, that it actually reduces the futures price. And so that's another explanation on the relationship between futures prices and spot prices is convenience yield. So now, I'm going to end it here for this part of the chapter. I mentioned at the beginning I would cover futures options. I'm not going to cover them in this video. I'm going to do a separate video on futures options because I think it's a separate class. And as I said before, I generally don't ask students to price futures contracts, except maybe extra credit on a quiz or an exam. Some of the concepts are important. The non-quantitative calculations part of it would be important, but not actually computing prices. So again, that'll be in a separate video, so look for that.